Hey there, future millionaires. Welcome back to our channel, your go-to spot for becoming mindful with your money. Today, we're diving deep into the psychology of investing and why your brain might be your biggest obstacle. But don't worry, we'll also show you how to hack your mind for smarter investing. Stick around because this is going to be a game changer. Alright, let's start with the bad news. Your brain is wired in ways that can seriously mess with your investing decisions. But knowing these pitfalls is the first step to avoiding them. So, let's dive in. First up, cognitive biases. These are mental shortcuts that can lead us astray. Let's break down a few of the big ones. The first is confirmation bias. Imagine you've heard that electric vehicle stocks are the next big thing. You do some research and find articles and forums confirming this idea. You get excited and invest heavily. But what you didn't notice were the articles discussing the challenges and risks in the EV market. Confirmation bias made you overlook crucial information. Always seek out different viewpoints to get a balanced picture. The second is anchoring bias. Say you're looking at a stock that's currently priced at $50. You remember it was $100 a year ago, so you think it's a bargain. But is $50 really a good price? Maybe the company's fundamentals have changed, or the market has shifted. Don't anchor to past prices. Focus on the current value and future potential. The third is hindsight bias. After a market crash, it's easy to say, "I knew that was going to happen." But did you really? Hindsight bias makes us believe we predicted past events, leading to overconfidence. Remember, the future is uncertain, and past performance doesn't guarantee future results. The last one is loss aversion. You bought a stock at $100, and now it's down to $70. You're holding on to it, hoping it will bounce back because selling would mean admitting a loss. But what if that $70 could be better invested elsewhere? Learn to cut your losses and move on. Next, let's talk emotions. Fear and greed are the dynamic duo of bad investing decisions. Fear makes us sell low when the market dips. You see everyone panicking, so you panic too. But often those dips are temporary, and selling means you lock in your losses. Greed, on the other hand, makes us buy high when everyone's talking about the next big thing. You don't want to miss out on the profits, so you jump in without doing your research. But by the time you hear about a hot stock, it's often too late. The smart money is already selling. Speaking of not missing out, let's talk about FOMO, the fear of missing out. It's that voice in your head saying, "Everyone's investing in crypto, why aren't you?" But remember, just because something is trending doesn't mean it's a good investment. Jumping on bandwagons can lead to big losses. Do your research and stick to your plan. Alright, now that we've looked at the pitfalls, let's talk about how to overcome them. With the right strategies, you can hack your brain for smarter investing. First, cultivate a long-term mindset. Investing is a marathon, not a sprint. A long-term mindset helps you ride out market fluctuations and focus on steady growth. Think of it like planting a tree. You won't see results overnight, but give it time, and you'll have something amazing. Historically, the market tends to go up over time. So instead of trying to time the market, focus on time in the market. The longer you're invested, the more likely you are to see growth. Next, diversify your portfolio. Spreading your investments across different assets reduces risk. Think of it like a buffet. You don't want to fill your plate with just one dish. Mix it up. Diversification can be across asset classes like stocks, bonds, and real estate. It can also be within asset classes, for example by investing in different sectors or countries. The key is to not put all your eggs in one basket. Now, let's talk about the power of compounding. Compounding is like magic. It's when your investments earn interest on interest. Start early and let time do the heavy lifting. A small investment today can grow into something massive tomorrow. Here's an example to illustrate the power of compounding. Imagine two friends, Alice and Bob. Alice starts investing $100 a month at age 25. Bob waits until he's 35 to start investing the same amount, assuming a 7% annual return. By the time they both reach 65, Alice will have around $150,000, while Bob will have about $74,000. Why the big difference? It's all about the power of compounding. Alice's investments had an extra 10 years to grow and earn interest on interest. Those early years make a huge difference in the long run. But compounding isn't just about investing money. It's also about investing in yourself. Every book you read, every skill you learn, every healthy habit you adopt, they all compound over time. So start early, be consistent, and watch the magic happen. Alright, let's wrap up with some practical tips. First, set clear financial goals. Knowing what you're investing for keeps you focused. Are you saving for a house, retirement, a dream vacation? Having a goal makes it easier to stay the course. Second, automate your investments. Consistency is key. Set up automatic transfers to your investment accounts each month. This way, you're always paying yourself first. Third, educate yourself. The more you know, the better your decisions. Read books, watch videos, take courses. The world of investing is always changing, so never stop learning. Fourth, have an emergency fund. Life happens, and you don't want to be forced to sell investments when you need cash. Aim to save 3 to 6 months' worth of living expenses. Fifth, review and adjust your portfolio regularly, but don't overdo it. Checking your investments too often can lead to emotional decisions. Instead, set a schedule, maybe once a quarter, and stick to it. And finally, consider low-cost index funds or ETFs. They're a great way to get instant diversification, and their low fees mean more money stays in your pocket. And that's it. Thanks for watching. Remember, your brain might suck at investing, but with the right mindset and strategies, you can hack it for success. Like, share, and subscribe for more mindful money tips. See you next time.